Most people think they're investing, but actually they're gambling. I've seen millionaires go broke because they couldn't tell the difference between building wealth and chasing quick wins.
This is me.
I remember back in the days when I started investing in real estate, I would go to a real estate conference and I would meet a bunch of other investors. They were doing what I was doing. They were flipping properties, buying, selling stuff. And at one point in time, I've noticed the guys who fly private jets and have big mansions and live the kind of style that I aspire to win. They always hold on to the properties long term. They don't buy and sell quick flips and speculate on arbitrage. So I started doing more of that and listening. The only difference between successful people and unsuccessful people is that successful people have habits of successful people. And one of them is buy and hold. Never sell if you don't have to. Fast forward, I adopted those habits and made them my own. And for years, I was always the buyer. As the old saying goes, you can sell it once, but you can rent it forever. I prefer renting it forever instead of having to go and find the next deals. 10, 15, 20 years go by, and I occasionally would run into one of those guys who started out with me. And now, 20 years later, I look at them, they're exactly in the same place where they were before. They're living basically paycheck to paycheck, except they're living a house flip to house flip, still flipping houses, and waiting until their next deal to fund their lifestyle. And they really don't have any net worth or wealth to show for all their years of hard work and all that creative deal structuring, negotiations. They're talented, they're no different than me, except I chose to be an investor for the long term, and they chose to be speculators looking for arbitrage and the next opportunity. And in this video, we're gonna talk about how to be an investor and not speculator. What's the difference between the two and how to avoid the pitfall that so many talented people fall into. I'm Nikita Zhitov, and over 20 plus years in commercial real estate, I've built a portfolio worth hundreds of millions of dollars, thinking like an investor, not a speculator. I've also watched brilliant people, much smarter than myself, lose everything because they confuse speculation with investment. Today, I want to show you the difference and why it matters for your financial future. You see, there are two types of people in business: builders and hustlers, investors and speculators. The difference is not just philosophical, it's the difference between sustainable wealth over a long period of time and boom and bust cycles. Most entrepreneurs, they start as speculators, but they never transition. Those who do become truly wealthy. You see, we live in a society, with social media especially, that rewards instant gratification. You see on Instagram some flashy person, making $1 million overnight, and you start to believe, the young people actually believe that it's possible. And when I see that, I think to myself, gosh, it wasn't that way for me. It took years of steady climbing, a steady building. Rome wasn't built overnight. It's one brick, steady, step by step, day in and day out, day in and day out. But we live in a society that, especially with younger people, they think overnight success is possible. Where you just walk to your kitchen, pour a glass of water, put a little tablet, it dissolves in it, and you drink it, and boom, you became successful like this. That's a bunch of crap. It doesn't work this way. Any successful person you're going to interview who built a big fortune, it took years of preparation, years of studying, constantly bettering themselves, constantly elevating their game, and that's what yielded the result. The compound effect kicked in from all that effort. But what most people do, they read the headline. Sometimes people read headlines about me, like, hey, we made $5 million on one deal in 6 months. We just bought an apartment building for $8 million. We sold it 9 months later or 8 months later for $13 million. We just made $5 million like this. But what they don't recognize is years of negotiation, recognition of value, knowing your zoning codes, knowing values, watching market conditions intimately, and timing the market opportunity, recognizing when the right time to buy and the right time to sell, and capitalizing on that. It took 20 years of effort and dedication to be able to make $5 million on a single transaction in a couple of hours of work. What are some of the common trends of investor mindset? You gotta focus on cash flow, not just appreciation. You gotta buy properties that pay you every month. You gotta think in terms of decades, not quarters or weeks or months. I used to make plans for 10 years, 3-year plan, 5-year plan. I walk into this mastermind for ultra high net worth individuals. And the first day, the first question I get asked, okay, what's your 200-year plan? I don't know, I haven't thought that far out. I said, well, you should, because you need to think in terms of centuries as far as planning, the legacy, the succession plans. Just a different way they think. And you gotta make sure that you adapt that way of thinking for yourself if you wanna be at their level. Create systems that work without you. Compound growth over time. I've been at this over 20 years, and sometimes I find myself at those investor conferences where somebody's pitching a new trick, a new idea, and it says, well, here's how you make $1 million in a week. When I hear that, I'm not interested, because I know it's a bunch of bullshit. That guy is not going to be around 5 years from now. It's easy to make money when it's 90 degrees outside and sunny. I want to find a way how to make money when it's negative 60 and you got a 50-mile-an-hour wind in your face and blizzard, and you can barely breathe because as soon as your breath freezes to your face. Show me a strategy that works under those conditions when interest rates are 18%, when it's severe condition and the banks are not lending. It doesn't matter what's your credit history. It doesn't matter what kind of price you're getting on the property. They're just closed for business. Show me strategies that work under those conditions. Show me that your project can survive these type of market conditions. Then I'm interested. I'm interested in investing with you as an LP or as a co-GP, whatever. What the difference between investors and speculators? Speculators show like, hey, if everything continues on this rosy path and we can get bridged debt on this multifamily project, because 2 years from now, when the time we stabilize and the rent's gonna keep increasing 10% a year, we're gonna exit it and we're gonna have a 0.25% cap rate compression. And we're gonna make $10 million, and it sounds wonderful. Well, what if interest rate expand 3 points instead of getting compressed a 0.25 point? What if this market rent increases stop climbing like we had in 2020, 21, 22 during COVID era, and actually your rental rate is going to stop dropping? What is it going to do to your pro forma? Are you still going to be able to make money, or are you going to go bankrupt? Investor sticks to their principle. They have their investment policy statement, IPS, and they stick with it. They don't deviate from it, because grass is not always greener on the other side. For years, I've only bought properties within 30-minute drive of my office. And to this day, probably 30 or 40% of my portfolio is within an hour radius of my office. If you listen to the greatest investors out there, like Warren Buffett, right, Ray Dalio, they believe you cannot outperform the market. If you just want to play the market, just buy S&P 500 and you're going to do pretty well. But trying to beat the market by speculating, by buying and selling stocks, day trading, you'll most always gonna end up a loser at the end of the day. The only way to beat the market is buy and hold the companies you believe in. They have strong fundamental values, and you stick to them, and you believe in them, and you just hold on to them for a long period of time. That's how big fortunes are made. In commercial real estate, it's the same thing. Find an area, believe in, that have long-term fundamentals, have good job growth, and stick to it. Don't try to go and all the way across town, here, there, and everywhere just to make a quick buck. Another common thing among speculators is, again, they think short term. They think, okay, how can I make money in the next 60 days by flipping something? Again, that's speculation. That's not investing. They constantly hunt for the next opportunity and living deal to deal. Have a long-term time horizon. You're an eternal being. You have many lifetimes to live with yourself, so you got all the time in the world. So plan for the long run, based on principles and foundation that you believe in. Investors plant trees, speculators pick fruit. Investors are long-term thinkers, and long-term thinking reduces risk. Market cycles become opportunities, not threats. Patience creates competitive advantage. Compound interest needs time to work. My best properties were held for over 10 years. Cash flow versus appreciation. Investors buy income streams, speculators buy price movements. Cash flow provides stability during downturns. Appreciation is a bonus, not a strategy. Tenants pay your mortgage while you sleep. Never depend on the market going up to make money. There is a difference in leverage philosophy between investors and speculators. Investors use leverage to acquire more assets. Speculators use leverage to amplify returns. Conservative debt to equity ratios, that's what investors are after. Or they're focused on paying down debt as quickly as possible to deleverage, to de-risk the deal. So focus on debt coverage ratios. Leverage should enhance, not create risk. Look, a good sleep well at night test is, can you handle the payments if income drops? If your plan doesn't work and the property doesn't lease, can you still handle the payments, right? So you got to maintain the risk balance equation. What also makes investors different from speculators is that investors have emotional discipline. They have financial literacy. They ignore market noise. Speculators react to every headline. Perfect example, like Nvidia was trading at whatever 135 in January, and then DeepSeek came out at the end of January of this year, and Nvidia stock dropped like 30% down to like 90s or maybe even mid 60s. People panic and sold. But in the end of the day, the underlying fundamentals of Nvidia stock is still the same. So what smart investors did, they doubled down. They bought more. They didn't panic and sell. But most, individual retail investors, they panic and sold. So it was going downhill. So the key is to stick to your investment criteria regardless of FOMO effect. FOMO effect is the fear of missing out. All of us have FOMO effect about Bitcoin because we didn't buy it at $10 a coin. Now it's $120,000 a coin. Yes, it's easy to have a FOMO effect about Bitcoin, but at the end of the day, if you believe in what Bitcoin is about and its fundamentals and its future, $120,000 a coin might seem like a big number, but if you really think about it, if you believe that it's going to go to $10 million a coin or higher, which I believe it will, you can still have an opportunity to buy it right now with a 99% discount. Let me emphasize this. Disclaimer, I'm not a financial advisor, but I just, again, my opinion, based on the research I have done on it. Investors know what they want, they have a conviction what they believe in, and they stick to their guns. They don't get distracted by shiny object syndrome or the grass is green on the other side, and they stick to the plan. They stick and they just execute on it. I guess that's the main case. Now, be honest with yourself. When you look at your last 3 business decisions, were you thinking like an investor or a speculator? Were you building something sustainable or chasing a quick win? Drop your answer in the comments. No judgments here. We all have been speculators at some point in time, but the key here is recognizing where you are and who you are, so you can keep it. You can adjust from this point moving forward, so you don't repeat the same mistakes, and that your future may be much more abundant than your past. In closing, I would like to say, here's the truth. Speculation isn't evil, but it's not wealth building. Some of the best investors I know started out as speculators, myself included. My very first commercial real estate deal, I basically wholesaled it. I speculated, bought it for 400, flipped it for 450. To me at the time, it was a lot of money, so it was worth doing it versus trying to hold on to it over a long period of time, because it gave me a capital to head start in this business, to be able to drop out from college and to get into this business full time. The key is recognizing when to make the transition. If you want to build generational wealth, start thinking like an investor today. Think 100 years out, 200 years out. Which one do you want to be? In Russia, there is a saying, the slower you go, the further you're going to get. Remember, slow and steady doesn't just win the race, it builds empires. Thank you for watching. I'll catch you in the next video.